Let's turn our attention to West Africa now. Nigeria's economy grew by 2.51% in the second quarter of the year. That's a slight increase compared to the growth that we saw in the first quarter of the year, 2.38% in the first 3 months of this year. That said, data from the National Bureau of Statistics for Q2 does indicate that the transportation sector, which makes up 0.9% of Nigeria's entire economic output, that contracted by 50.6%. Overall, the road transport subsector shrunk by 55.14%. The road transport subsector makes up over 95% of the transport and the storage sector in the country. And that, of course, is responsible for the movement of both goods and persons up and down Nigeria. The Bureau did not give an explicit explanation for that decline, but some analysts say if you're looking for a culprit, look no further than the fuel subsidies removed at the end of May. But is that really the case? Let's pass the data coming out of Africa's largest economy. Segun Sopita is the principal partner at Woodridge Scott Consulting, is joining us live from Lagos tonight. Thank you for your time this evening, sir. So that 50.6% contraction by any account, huge, absolutely huge. But can we trace all of this directly to the removal of the petrol subsidy at the end of May, or is there more that explains that contraction?
Well, thanks for having me, Rama. Yes, you are absolutely correct. The transportation sector, the drop in the GDP of the transportation sector can be directly linked to the fuel subsidy removal. And because the reaction to these types of changes in that sector is very quick, there is almost no lagging effect at all. It's not surprising to see that very sharp drop in that sector. However, it must be said that the overall relatively poor performance of the GDP cannot be traced only to the fuel subsidy removal. We'll recall that the fuel subsidy removal happened in the last month of that quarter. So the effect of that would only be have an impact in the month of June. Out of 3 months, only 1 month. So yes, there's an impact as a result of the fuel subsidy removal, but there are other factors at play that's resulted in this rather sluggish GDP growth rate for that quarter, especially if you compare Q2 2023 with Q2 2022. You find that there is a sharp over 1% decline from 3.54 Q2 2022 to what we have now. That can be traced, I think, in my opinion, directly to the continued battle by the CBN with inflation. So the CBN has had this unfortunate need to balance the need for growth with the need for taming inflation, which, as we know, is trending above 24% as we speak now. So the continued increases in interest rates has tempered economic activity and economic growth, and that's actually what we're seeing. But yes, the fuel subsidy removal has had a terrible impact on the transport and logistics sector, and we will see a whole lot more of that when Q3 results comes out. And I dare say that it will not only impact that sector, we'll probably see more of an impact across the entire economy.
Indeed. Sorry, I'm going to deviate slightly here just to follow up on something that you said with respect to how the CBN is handling inflation. I mean, they can't really go, the full Paul Volcker on trying to deal with inflation by raising rates, because the things that are driving inflation in Nigeria tend to be on the fuel side and the food side. And both of those factors really can't be affected by monetary policy to an aggressive extent directly by rates. So that approach does have its limitations, doesn't it?
Absolutely. And, a lot of us as analysts and watchers of the economy have been saying this for several months. We've been cautioning the central bank to adopt a more holistic strategy towards taming inflation. Addressing the Nigerian inflation problem with monetary policy alone is just scratching the surface of the problem. Fiscal policy and overall government policy initiative across several sectors will need to be brought into to bear to deal with the inflation problem. One can only hope that the central bank will listen to this and slow down the continued increase in interest rates.
Indeed. Let's focus on one specific sector. I want to use mobile phone companies, MTN and so on, as an example here. They tend to be heavily reliant on diesel and renewables, or at least a mix of those two, to keep their transmission masts online, given how unreliable power from the grid tends to be. So in this quarter, we've seen, especially towards end of May going into June, fuel prices more than tripled. The Naira has also essentially been let loose a little bit. It's gone all the way to 770 something against the dollar in the formal market. How are companies like these coping with a surge of that magnitude?
So like you've said, the base stations of these telecoms operators are primarily powered independent of the public power supply grid, and that comes with a huge attendant cost implication as far as the operational cost of doing business for them in Nigeria is concerned. However, it's important to note that the deregulation/subsidy removal that we've seen happen in the last 2.5 months has primarily affected petrol prices only significantly. Diesel had been deregulated before now, many years before now. There hasn't been any subsidies on diesel and on kerosene prices for many, many years. So the increase that we've seen in diesel prices has had to do more with the devaluation of the Naira as a result of the unification of the exchange rate policy of this government, as well as addition of a few taxes, value-added tax on diesel costs. That has seen diesel prices go up, well, significantly, but nowhere near as sharp as petrol prices. So we will see increase in cost of doing business for these organizations as far as maintaining their base stations is concerned. But I think the bigger impact on their operations will be in the cost of, just their overall administrative expenses and overheads with regards to fueling their fleet of vehicles. And of course, we know these are large organizations with operations that cover the entire country, and therefore they have, very, very large fleets. Whether they own those fleets or those fleets are outsourced, the impact of this on their cost of operations will be significant. So obviously you would expect that this cost increases will likely be passed to the consumers, and you'll see that also become a factor in cost push inflation. So again, you have to wonder whether these policies have been very clearly thought through with regards to how it will impact the entire economy of the country.
Indeed, MTN's numbers for Q2 and Q3 will make for very interesting reading. One last question for you. I remember during the inauguration at the end of May, Aliko Dangote said that the first batches of fuel for the retail market from that refinery, the 650,000 barrel a day facility, should essentially be hitting the market by August. We're at the tail end of the month now. Is the refinery feeding the local market? Might it have the ability to at least moderate prices, keep them essentially where they are now for the foreseeable future?
Well, sadly, the Dangote refineries, the Dangote organization has come up with an updated information to say that August 2023 is no longer a realistic takeoff date for them to supply refined products into the markets, into the local markets. In fact, reports are that we could see this deadline shifted by to as far as 2025. So there's a lot of uncertainty in that space. Definitely August will not happen anymore. But even if it were to happen, it's important to note that the impact of the coming on stream of products from this refinery on prices of refined products might not be as significant as some might hope. And this is because crude will be supplied to the refineries at international prices, which means that to a very large extent, the only component of the price at the pump price, at the pumps that you will save will be the freight and logistic costs of bringing those products from abroad if you are importing them. Now that you're producing locally, you would not bear freight charges, but you will still bear local transportation charges, from the refinery to the rest of the country. So you won't find a significant effect on the overall pricing of refined products at the pumps, because everything is still benchmarked against the US dollar and against international crude prices. And this is the conundrum for Nigeria. How do we ensure that local production has a significant impact on local prices of these refined products? Subsidy, subsidy, subsidy may very well be the answer.